Requesting a commercial loan quote based on L.T.V. alone is like calling a car dealership and asking the price of a red car. The color tells you nothing. The dealership cannot give you a number because you have not given them anything meaningful to work with. That is exactly what happens when a broker calls a commercial lender and opens with an L.T.V. request. And it happens constantly. Let me give you two real examples of what this looks like. Then I'm going to show you what lenders actually need before that conversation can go anywhere. A broker calls and says, "I have a borrower who needs a loan at 75% L.T.V. That is the entire submission. No property type, no occupancy, no income, no expenses, just a number." Here is the problem. In commercial lending, the L.T.V. is not the starting point. It is the finish line. The lender works forward from the income, not backward from a leverage request. To begin underwriting that deal, a lender needs to know the net operating income. That is what the property actually generates after vacancy and operating expenses. From there, the lender applies the debt service coverage ratio test. Most commercial lenders require a minimum of 1.20 to 1.25 times coverage. That means for every dollar of debt service, the property needs to generate at least $1.20 in net operating income. If the income supports the requested loan amount and the D.S.C.R. clears the threshold, then L.T.V. enters the conversation. Not before. So when a broker leads with 75%, the lender's first thought is not, "Can we do that?" The lender's first thought is, "Do we even have enough information to know?" In that submission, the answer is no. Now here is a more sophisticated version of the same mistake. This one is dangerous because it looks like a strong deal on the surface. A broker submits a construction loan request. The appraised value is $50 million. The requested L.T.V. is 40%. Low leverage. Big project. Sounds conservative, right? Not so fast. The first question a construction lender asks is, what is that $50 million based on? Is that the as-is value of the land and existing improvements? Or is that the stabilized value, meaning the projected value of the completed and fully leased project? Those are two completely different numbers. If the $50 million is the stabilized value, that 40% L.T.V. looks a lot less conservative once you ask what the project cost to build. Total project cost includes land, hard costs, soft costs, carrying costs, and reserves. That is what drives the loan-to-cost calculation. And loan-to-cost is what construction lenders underwrite to, not loan-to-value. If total project costs are $38 million, and the borrower is requesting $20 million, that is a loan-to-cost of over 52%. And we have not even gotten to the most important question in construction lending. Who are the sponsors? What has this borrower built before? Do they have experience with projects of this size and complexity? Do they have the liquidity to fund cost overruns? Construction lending is as much a bet on the borrower as it is on the project. A low loan-to-cost ratio with an inexperienced sponsor is still a difficult deal to get done. That 40% L.T.V. submission told the lender almost nothing. The appraised value basis was unknown. The loan-to-cost was unknown. The sponsor's experience and financial strength were unknown. L.T.V. is not a substitute for underwriting. It is a single data point, and not even the most important one. So, what should a broker bring to a commercial lender before asking about terms? For an income-producing property, you need 5 things before the conversation is worth having. Number 1, property type and occupancy. Not just commercial. Is it multifamily, retail, office, industrial, mixed use, or self-storage? What is the current occupancy rate? Number 2, the rent roll. Every tenant, their lease expiration, and what they pay. This is not optional. It is the foundation of the income analysis. Number 3, the trailing 12-month operating statement. Actual income and actual expenses over the prior 12 months. Not a pro forma. Not an estimate. What the property has actually produced. Number 4, the purchase price or existing debt. For a purchase, the lender needs the contract. For a refinance, the lender needs the current loan balance and terms. Number 5, basic borrower information. Entity structure, ownership percentages, and a general sense of the borrower's experience and liquidity. Credit score is the least important item on this list. For a construction deal, the list is longer and the stakes are higher. Number 1, total project cost breakdown. Land, hard costs, soft costs, contingency, carrying costs, and reserves. All of it. Number 2, the basis for the appraised value. As is, as stabilized, or both. If it is the stabilized value, you need the assumptions behind it. Number 3, the development timeline. Construction period, lease-up period, and stabilization target. Lenders are underwriting to an exit, and they need to understand how long their money is out. Number 4, sponsor experience and financial strength. Prior projects of similar size and type, current liquidity, and net worth. This is not a formality. It is a core credit factor. Number 5, the takeout strategy. How does the borrower plan to exit the construction loan? Permanent financing, a sale, or a recapitalization? A construction lender wants to know there is a realistic path to repayment before the shovel hits the ground. Here is the bottom line. L.T.V. is a ratio. It tells you the relationship between a loan amount and a value. It does not tell you whether the property cash flows. It does not tell you whether the borrower can execute. It does not tell you whether the deal makes sense. Leading with L.T.V. in a commercial loan conversation signals immediately that the broker is thinking about this the wrong way. The brokers who are effective in commercial lending come to the table with the income story already assembled. They know what the property earns. They have done a rough D.S.C.R. calculation before they pick up the phone. And they are asking lenders about structure, not asking lenders to do their homework for them. If you want to understand how commercial loan underwriting actually works, that is exactly what we cover at the Academy for Commercial Lending.